But even though it was a rough day, and let's be honest, a rough year, it's important to remember this. These kinds of corrections do happen. Stocks, they do go down. And that can often lead to opportunity for savvy long-term investors out there. Let's talk more about this with Anastasia Amoroso, Chief Investment Strategist at iCapital, and CNBC contributor Megan Shue, Head of Investment Strategy at Wilmington Trust. Both of you, thank you. Megan, I'll begin with you. I'm sure your clients are calling, texting, emailing, WhatsApping, carrier pigeon. However they do it, they're asking you, what the heck is going on? What is your answer?
Yeah, well, we've been telling our clients not to panic, but to remain patient, particularly in deploying excess capital. I would say that the market is starting to look a little bit more interesting, and it would probably take just another couple of days like this for us to be starting to talk about deploying some of our excess cash, which we have held an above benchmark weight to cash for the past few months. And I think I'm actually a little bit reassured by what we're seeing in the market and the correction taking place, because I really do think the market needed to readjust to the growth expectations for this year. And the multiple needed to come down to account for tighter monetary policy and less liquidity in the market. And so as we look ahead from these levels, I think we're setting up for a really potentially nice balance of the year, but it's certainly painful now. And, I can't say that we're done.
Painful on the way down. And by the way, very, very smart of you guys, or prescient or lucky, holding excess cash. Megan, back to you in a second. Anastasia, to you. Megan said, if we get a few more days like this, do you think we'll get a few more days like this?
Oh, right. I think it's anybody's guess. But here's what I would say. It's been a struggle, and I actually continue to expect it to be a struggle for the markets, because I think today had a couple of realizations for investors. And the first one is that we seem to be expecting these near-term relief rallies, but they end up being relief moments. And the reason for that is because there's so much event risk on the horizon. And, we get the Fed Chair Powell to say there's not going to be 75 basis points, and this causes a relief moment. But guess what? There's more event risk on the horizon, whether it's the CPI for next week, whether it's the jobs reports or something else. And this is a time and day. This is such an environment where it is so highly uncertain. It is very difficult to guess and hope, for example, that the CPI number comes in better than expected. And investors are just not in the mood to guess. And so, Brian, when you look at what investors are doing, first of all, hedge funds are not buying equities, and real estate investors are kind of stepping in. But I'm afraid that given this choppiness, we're going to start to see some of that go back as well. So I think there's a great lack of conviction, and because of it, there's not an appetite to guess at events. But the second thing I would say,
well, Anastasia, let me jump in for 1 second here, because I want to go back to the economic numbers, and I'll go back to Megan. But first, to you back again, Anastasia. We've got the jobs number. The monthly jobs number is out tomorrow. Now, this is a Fed that is trying something extremely difficult. They are trying to thread that perfect needle between crushing inflation but not sending us into a recession, like Steve Leishman said. So is the odd irony that if tomorrow's job number comes in really, really good, you think great economy, it goes to be more inflationary and thus could actually be a negative for the equity market?
Brian, again, I think whatever the number is tomorrow is going to be something different that the market is going to focus on next week. And whether it's the jobs number, whether it's the housing market, I think the reality is in front of investors today is the outlook today is going to look very different 6 months from now. We're going to have higher rates that are going to start to slow down the economy more so than they already have. And so as a result of that, if you look at the earnings for the S&P 500 companies, they're not going to be revised up. They're going to be revised down. And so this, in my mind, is what caps the move higher in equities. And I'm not sure that we're going to see new record highs this year. I think it's going to continue to be the struggle until two things happen. Either inflation peaks and really declines convincingly, and or the Fed pivots because, to your point, they're trying to strike this perfect balance. For now, I just don't think that's imminent.
It seems like you and everybody else. There's so much bearishness out there. Anastasia, Megan, back to you, because you had talked about maybe deploying some of that cash if things go down. Listen, there is an upside to higher rates, is there not? Traditionally, banks and big financial companies, they like higher rates, something called the net interest margin. They can make more money off that. Trading volumes for the biggest banks, they're higher right now. Maybe their trading desk could do better. are you ready to leave us with some opportunity? Are banks and financials a good bet right now?
Yeah, I would say financials are certainly going to benefit from higher rates. And absent a recession, if we just get a slowing economy, which, by the way, is our base case, we've certainly revised down our GDP outlook for 2022, but still expecting about 2.4% for the year, which is a solid pace of growth. And if that plays out, which is very much dependent on inflation coming down, then I think banks, large money center banks, will be well positioned to benefit from the higher rate environment. And also, as rates move higher, we have to start to think, we've had an underweight to bonds for a while now. Bonds are going to start to get more attractive as well as you get those higher yields. And they're still going to have their place as a safe asset. And I don't think we're going to see a repeat of what we saw in the first 4 months from a bond perspective. But it really does depend on rates. Brian, I think your point about the job market is really important. In fact, I would say maybe more important than the Fed meeting was the JOLTS report this week, and the fact that we have basically 2 job openings for every unemployed. That needs to come down in order for us to start to see inflation slow.
Yeah, the job opening and labor turnover survey, I think you're right, a better indicator than the monthly jobs number, which, by the way, out tomorrow at 8:30 a.m. Megan and Anastasia, thank you both very, very much.